Good morning, everyone, and welcome to today's Tuesday Market Outlook webinar. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play, and today I'm going to be giving you my thoughts and analysis on the current market. So before we get started, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today, we'll be starting off with the major equity indices, highlighting those key levels. We are seeing a bit of a pullback here for the major indices across the board, largely due to maybe some contagion concerns from Chinese data being quite poor. But after a significant rally in the last few months, I do think it's time for a pullback anyway. From there, we'll be moving on to fixed income and commodities. We'll take a look at the sector rotational model, highlighting which sectors are outperforming and underperforming the overall markets. We'll take a look at some subsectors of interest that I have for you today, and we'll end today's webinar with some bullish and bearish market observations. So starting off here with the S&P 500 using the SPY ETF. And here's the pullback that we've been talking about, right? From this just around 460 area, that's where we started to see signs of this pullback. A bit of a rejection and a pretty bearish day on Friday, bit of a recovery yesterday, but price set to open a good bit lower this morning. So there are concerns from Chinese data that it's, obviously being the second largest economy in the world, that global demand should or would decline, and therefore we are seeing this pullback. But if you take a look at the bigger picture, the bullish structure remains intact. And this pullback isn't like, sell-offs where you tend to see a very violent move to the downside. It's not, it's not a significant pullback. There's no significant bearish price action. So I wouldn't view this as too much of a threat to this overall bull rally. I do think there's a bit more room to the downside, perhaps at 445 here for the S&P 500, simply due to the fact that this was a previous area of resistance before the earnings season kicked off. Once earnings season kicked off, we saw a breakout there, a rally to 460, and now we are seeing a bit of a pullback here, for the S&P. So overall, I'm not too concerned about this pullback. If anything, it provides some good buying opportunities. Look at 445 to see if there's any bullish price action or better risk reward, bullish opportunity. And if we see a break below that 445 level, we also have the 55-day exponential moving average, which tends to provide some support, as you can see in the past. So that would be the next dynamic level of support to be looking at here for the S&P. In terms of the upside targets, over the next few months, I do expect price to eventually rally back to the 470, 480 range, because right now consumer spending is still quite strong, although there is a little bit of loss of momentum in that regard. And markets are also pricing in a more dovish Fed. So we'll be looking at inflation data, jobs data. Jobs data came in better than expected or lower than expected last week, which is actually good news in a high inflationary period. So if inflation data comes in lower than expected this Thursday, well, we could see a move higher or bounce higher for the S&P 500. That could very well be the fundamental catalyst for that move. Moving on to the NASDAQ 100. So we've seen price break below its 21-day exponential moving average, but it's still very much in a bullish structure. We're seeing price just above 370, set to open a little bit lower this morning. And if you're going to break down below 370, we still have 360 to look out for as the next horizontal level. But we also have the 55-day exponential moving average. So this area between 370 and 360 could be a good risk reward bullish opportunity for the NASDAQ. But the NASDAQ has been outperforming the S&P due to its higher exposure to technology and growth names. And now we are seeing that a bit more underperformance relative to the S&P. And that's just simply also because of the fact that technology has been providing a lot of leadership in recent months, and we are seeing a bit of a natural rotation out of technology and into the broader market, which isn't necessarily a bad thing for equities, because it indicates broadening participation in this rally. So even in the Nasdaq, losing some steam relative to the S&P, the bullish structure still remains intact, like the S&P. And I'm not too concerned about the bearish price action that we've seen. Normally, when you are concerned is when you see a market sell-off, which tends to be a big move to the downside. Instead, we've seen a very structured move in the last couple of weeks, very choppy price action as well. Okay, taking a look at IWM, which is the Russell 2000 ETF. So small caps are actually pulling back, and now there's some underperformance relative to S&P. And that seems to be a bit of a pattern here, where we start to see some small cap outperformance for a couple of days and then immediately underperformance not too long after that. We have the 200 level, or the area between 198 to 200, playing a major area of resistance now. I was looking for a potential breakout above 200 and a continuation to 210, which was the 23.6 level, but there just isn't enough momentum. We are seeing momentum decline. Price set to open significantly lower this morning, and that could be an indication that there could be more towards this decline back towards 188, which is a 38.2 fib level. Either way, I'd still be playing this range. Now that we've broken above the 38.2 fib level, if we do get a pullback, I'll be looking for a potential retest of 188 before a nice risk to reward bullish entry point. Okay, taking a look at TLT, and there has been some massive moves here since we last spoke in TLT. TLT breaking below a major support level at 99 to 100, and breaking below the significant bearish momentum. As you can see, the 50-period CCI, it actually shot past 200, or minus 200, and was very close to minus 400. And I would normally consider minus 200 to be a heavily oversold condition. So the fact that it got to almost minus 400 just indicates how heavily oversold TLT was. Now, what we are seeing here is a bit of a recovery in price, especially from an oversold condition, and that's to be expected. Potential retracement higher all the way, potentially back to 99 to 100, but that would be the area of previous support, and it could potentially turn to be resistance. So the big question is there more to this downside, or is this just a retracement higher before continuation lower, or is this going to be maybe a short-term false breakdown and you see price actually recover back above 100? Either way, now is not a good time for shorts on TLT because of the oversold condition. And what I would be looking for is a retracement back to 99, 100. Looking at the price action at that level, is it rejecting that level, or is it actually breaking back into this range? And if it is rejecting that level, then we look for a bearish play with a downside target of 92, which is the absolute downside in my opinion. I'd be surprised to see price break below that 92 level. Okay, taking a look at the US dollar. So the US dollar has recovered very, very well, broken above a few key levels. We have 101, 102, we have the 21 and the 55-day exponential moving average. And in the last 2 weeks, we have seen price break above all of these levels. Came back to retest towards the end of last week, the 102 level, and already this morning moving higher with some very strong momentum. 103.50 would be the next key area here for the dollar index. But if it breaks above that, you're looking at around 104.50 as well. That's the next horizontal level. So yeah, after a very, disappointing July for the US dollar, start of July, we have seen a recovery pretty much back to those normal levels where it's been trading at for most of this year. Okay, moving on to gold. So gold ran into resistance at around 184. That has been the level that we've spoken about for the last few weeks. And there's been some very choppy price action, but it has been bearish, especially when it moves inversely with the US dollar. So the fact that the US dollar is managing to recover, we are seeing gold decline. We also know that gold is a safe haven. And we may see some rotation back into gold, given the fact that there is some uncertainties with markets right now from China. But I don't expect that to last long because those uncertainties have been there for quite some time. So we are seeing now, that continuation of this bearish price action, a gap down this morning. So the last time I checked, and the next key level that I'd be looking at is at 177 area. That would be the next key area of support for gold. And if it breaks below that, you're looking at 170, pretty much 170, 168 as the next key area here. I'll go to the downside. Okay, moving on to oil. So for light crude oil futures, in the last few weeks we've spoken about this. There's been a few key developments, right? 74, this is the first key development. We saw a breakout above that level, perfect retest and bounced higher. And we were targeting over the last few weeks at 81, 82 area, or 83, I should say, the red line here, because that was a major area of resistance. And price initially did run into some resistance there, but wasn't really moving that much lower. Actually, was looking like there was a potential breakout on the cards, but so far this morning, we are seeing a very bearish day, significant decline. Poor Chinese data plays a huge part in where oil moves due to the fact that it has such a huge impact in oil demand. And this bearish candle, to start off the week, really, is going to be quite significant, in my opinion. I think there is a good risk to reward bearish entry point for a move lower. I'd be looking at oil companies or energy companies that have a high correlation to oil prices to gain this bearish exposure here for oil. But either way, it did reach our upside target and actually rejected it perfectly here, and it is moving lower. So taking a look at the sector rotational chart, we have 7 sectors in the improving and leading category and 4 in the lagging and weakening category. I will change that. Apologies for that error on the slide deck. So in the leading category, we have discretionary, the only sector in the leading category, and losing out on some relative momentum and relative strength. Communications and technology seeing a lot of outward rotation. Well, especially for technology, for communications, we've seen that outward rotation already, and now it's just losing out on relative strength, heading towards the lagging category. And when these 3 sectors start underperforming, rotation goes to the smaller sectors, the defensive sectors, or even like materials, industrials. These sectors have a lower weighting in the S&P 500, and we are seeing the rotation back into these sectors. Which if you consider the fact that overall equities have been rallying in the last few months, it's a positive to see now that these other sectors are participating in this rally, because for the majority of the last few months, we've seen all these sectors in the improving category actually stay in the lagging category for quite some time, and only discretionary communications and technology providing leadership. So in the improving category, we have quite a few developments in the last few weeks. We have energy, obviously with the move higher in oil. However, that could change if oil continues to move lower. We have financials still performing somewhat well, finding that relative strength. We also have materials and industrials, especially looking like it's going to be rotating towards the leading category. Real estate, not too much rotation, but it is back in the improving category. And we have healthcare just touching the improving category this week. So still underperforming compared to the other names in the improving category. But the fact that there is a bit more, let's say, concern with the overall macro picture, I wouldn't be ignoring these defensive sectors the way I have been almost in the last couple of months. I think, defensive sectors, there's a good time to be invested in them, and that's when there is uncertainty in the markets. And I do think there's a bit of uncertainty creeping in with regards to China. However, with the inflation reports on Thursday, if that turns out to be better than expected, I would say, that would pretty much negate the uncertainty from China. And I wouldn't be surprised to see equities continue to push on higher, and perhaps rotation into the more growth-driven sectors like discretionary, technology, and communications. We still have utilities and staples as well, our other defensive sectors in the lagging category, but finding some relative momentum. So taking a look at some of the subsectors that we've had really for the last couple of weeks, we have XRT. This is a bullish idea ever since price broke above that 62 level. And so far it's been working out well. However, we are seeing a decline in momentum. And price pretty much topping out at around 68, which was a previous area of resistance as well. So I do think now is a good time to be taking profits, or even just partial profits if you want to wait for potential breakout above 68 and a continuation of this rally to 73, 74. But the fact that price is losing a lot of momentum now, you definitely want to manage this trade in some way or form. So either taking partial profits now or taking the full, closing out the full position. Either way, it was a decently profitable trade idea. You're taking a look at a not so profitable trade idea, and that was TAN, the Invesco Solar ETF. So what happened here was last week, I was looking at price at around the 67 area, major area of support, and I was looking for potential nice risk reward bullish entry points. However, price actually immediately went against us, a gap down lower, with price at around 65, and it has been quite bearish ever since. Yes, there's some additional support just above 55, but this is a great example of when you'd probably want to close the trade as soon as it invalidates that thesis. And that in this case, as soon as it gapped down, that's when you would have wanted to close the trade. So unfortunately, did not work well for us, but you know, these things do happen. And you just have to kind of be disciplined and move on to the next trade. Moving on to General Motors, GM. So GM was a bearish idea that we've had ever since, I think, about 3 weeks ago or so, when price was at around 39.40. The thesis for this trade was a rejection of that level, and this is a major resistance area. And since then, you know, it has been going quite well for us. Set to open a good bit lower this morning. I'd be looking to take partial profits at this area, given that short-term momentum is approaching an oversold condition, and let the rest of the trade run to see how much lower it can get. You know, if the price breaks back above that 55-day EMA, you probably want to close the entire position. But either way, a very good bearish trade from a few weeks ago. But moving on to AMD, which was actually a bullish trade idea. So AMD, the whole idea behind AMD was, even though, you know, price had this huge bullish move, since then it has lost out on a lot of its momentum, but it's been maintaining this 110 support level. And that made it a very nice credit spread opportunity, because there is still bullish structure, there is still potential for a move higher. However, the lack of momentum could make it a bit more neutral, and that's where credit spread really thrives. So, you know, over the last few weeks, there have been multiple entry points at 110 to get into this trade. And the fact that it's at the top part of this range, just shy of 120, does indicate that if you had gotten into this trade a few weeks ago, this would be a good time to take partial profits. However, if you got into this trade more recently, I think it still makes sense to keep onto this trade, because the bullish thesis has not been invalidated, right? It's still, price is still staying above that 110 key area. So a new idea that I have for you today is actually Tesla. So Tesla, as you can see, has been on a very strong bullish rally, pretty much 2020, the whole of 2023 so far. However, like AMD, we saw this initial move higher, followed by a decline in momentum, but price still respecting a key area of support, which in this case is the 240 level. We saw a rejection or an intraday bounce of that yesterday. Price set to open a little bit lower this morning. We know the CFO of Tesla has left the company, so that did create some volatility. But that being said, you know, it's not a big enough reason to go bearish on Tesla, even for the short term. This area still provides a good risk to reward bullish opportunity at around 240 for continuation higher. And like AMD, I'd most likely be looking at a credit spread opportunity as opposed to a debit spread opportunity due to the lack of momentum. Moving on to another very similar looking chart, and that is Oracle. So Oracle, nice legacy technology name, you know, probably one of the lower risk technology names in my opinion. And you have this 115 level acting as support after this big impulse move. As usual, the momentum has declined, but price respecting that level. So Oracle's outperforming its sector. You know, even though it's set to open a little bit lower this morning, the bullish thesis for this trade still remains intact. And therefore, I would be looking for a nice risk to reward bullish entry point for continuation higher here for Oracle. Most likely a credit spread opportunity would be the best in this case. Yeah, and taking a look at Zoom. So Zoom was a bearish pick from last week when price was at 74. The reason we went bearish here was because of multiple rejections of that level. As you can see, 3 strong rejections of that level. And so far, this is a trade that's going very well for us. Price now at 67. set to open a good bit, or set to open at 67 this morning. And we do have earnings coming up. So, I think it makes sense to potentially take partial profits now, let the rest of the trade run if it continues to decline, and get out of the position before that earnings announcement. So a simple technical setup here, but proving to be quite effective here for Zoom. And finally, we have JP Morgan, which was an idea to put on your watch list from last week. So JP Morgan, when you look at the major banks, is the best performing bank, right, in terms of relative performance. And we saw this huge breakout above 145. Price running out of a bit of steam just shy of 160, momentum declining, but price still remaining quite neutral. Set to open a little bit lower this morning. And once price breaks below the 21-day exponential moving average and heads to the 55-day exponential moving average, that's when it starts to be looking for long opportunities. As you can see, that 55-day EMA has provided some support here in the last few months. So looking for a downside move. I'm inherently bullish on JP Morgan, but I'm waiting for the downside move towards a 55-day EMA just to provide a better timing and a better risk to reward bullish entry for a potential move higher back towards 165. And with that, that is all I have for you today. Thank you so much for joining me, and I hope you all have a great trading week. I will see you tomorrow for a Firstrade education webinar, and next week as well for another Tuesday Markets Outlook webinar. Thank you so much, everyone.